Hello, everybody. Welcome to Friday. Looking forward, as always, to our session today and getting into a really good discussion about what's going on in the market and some of the positions that we're looking at and paying attention to as we get things rolling. Market is just getting started. Feels like I should be ringing a bell or something as we've changed our start time on this live stream to to the opening bell time. So it's kind of interesting to see how that changes some of the things we're looking at. Instead of being a couple of hours into market activity already, we are here right at the open. So that's kind of fun. Looking forward to being able to talk about some of the open trades that we have. Hopefully, we'll have some time for looking at some of the stocks that you may be looking at as well. So feel free to share those. If you have comments during the live stream, please do feel free to use the chat feature. I'm going to be paying attention to that throughout the course of today's session in case you have questions or comments. Really quickly, by way of just some basic housekeeping, I just want to talk about a couple of different ways that you can get in touch with me, communicate with me as well as with the community. If you are on Discord, there's a couple of different ways that you have the ability to communicate that I've set up. This is just for people who have Plus access. And if you're in this webinar, if you're in this live stream live, that means you. You can use the open discussion forum or channel, I guess I say, to communicate and send messages to me or even just with the community. I've set up this channel as a way for us to try to share ideas, not only with me but also with other people in the community. So feel free to use that. I know Jay and Barry have used that a little bit for us. I want to try to expand that use as much as possible. So if you're in Discord, feel free to use that. I do watch that throughout the course of the day. And if you send me a message, I'll try to respond. Also, Discord has a direct message feature here, just in the top left corner of the Discord app, where you can directly message anybody that you are any servers that you're connected to. So I don't see me here because this is me, but what you should see on those left hand side under direct messages, just as I have Traders Pro and some other servers that I'm connected to, you'll see me, and you can just select that and then send a message to me there. These are probably a couple of the most direct ways, if you're on Discord, to reach out to me. You can also send me an email at rebelincomesystem at gmail.com. If you are on Substack, then you also can reach me there. Let me switch over to this one. Here we go. A couple of different ways that you can message me are in the chat area. This is an area that I have set up again, kind of like with the open discussion channel on Discord. Just an area where where if you're one of the paid subscribers on Substack, you'll be able to message me and also interact with the community. And so feel free to make use of that as well. Okay. So with that said, it is Friday as always. That means that we're looking at expirations of weekly options. And this is also the third Friday of March, which means that besides weekly options, we're also looking at expiration of standard monthly options as well today. So there's a number of positions that I've been following for the last month that were also set up for expirations today. So I'm going to just run through those really quickly. And if you, again, please feel free to share comments with me here. If you've placed similar trades as I have on these some of these stocks, and you have different numbers you'd like to share with me and with the group, feel free to do that. It's always interesting to see the differences in how we may be placing or considering some of these trades. So the first one, excuse me, is a put sale that I placed on in the second week of February on General Mills, stock symbol GIS. Now, my normal method and my usual preference when I place these trades is to try to work with expirations that are less than 30 days. I'm trying to leverage the element of trading frequency as much as I can, and so by placing trades with shorter expirations, we're able to place more trades if we're able to generate 1.5% or more on each one of those trades. Then the less time we can sell, excuse me, that means that we'll be selling more frequently, therefore making more money. This is a trade that was a little bit outside the norm because of the expiration that I was working with, which was 37 days. That's a reflection of a couple of different things. One was just the way that the pricing was working out at the time. But another one is the reality that this is a stock that does not offer weekly options. And at the time, the options that were nearer to expiration were just not that attractive. There was only about 7 days left, and pretty much there was very little in the way of implied volatility going on to try to give any kind of a boost to inflation, or excuse me, to option premiums. So the stock is sitting at just a little under 59 right now. I sold the 57.50 put. That means that the contract that I had sold, give me just a second here while I pull up my drawing tool. I apologize. I try to have this going before. There we go. Okay. So this is the contract that I was working with, 57.50. And again, for reference on this one, this is a useful trade, even though it went an extra 7 days beyond my normal threshold. It's able to generate about 2.43%, bringing in $1.40 per share in premium. With the stock pushing, actually just now pushing above 59, that means that 57.50 is certainly looking like it's going to expire worthless. And that's, excuse me. Early morning, I have a little bit of still have a little bit of frog in my throat. I apologize. That certainly means that this option is set to expire worthless, which is nice. That's not necessarily the preferred action or what I'm shooting for when I'm selling these put options. If the option does expire worthless, that is a good result, not necessarily the only result that is good. But in this case, that means that the option is likely to expire worthless. I could buy it back. Right now, the asking price on this is 5 cents. Considering the distance between the stock's current price and 57.50, it's also entirely possible and likely, even given the amount of open interest and even a little bit of volume already early in the trading day on this, that I could, if you wanted to try to close this out before the market closes, my normal method here is just let the option expire worthless, and then take the capital that I reserved in this trade. In this case, selling one, I sold one contract, so I have $5,750 in reserve. I'll just let that expire, and then it takes about 2 days following the close of the market today for that trade to settle and for that capital reserve to come back into my account and be useful again. So there might be an advantage if you don't want to wait that extra 2 days to buy this back, and maybe you just take the 5 cent asking price. I brought in $1.40. That would mean that I'd hang on to $1.35 of the premium I brought in. If I wanted to try to maximize that even more, again, we're talking about just a few pennies, but I could also put in, I could also probably put in an ask price of 2 cents. And if I'm willing to wait out the market for the next little bit, there's a good chance that I'll probably get that price. The advantage of being able to do that now is that 5,700, excuse me, $5,750 in capital reserve becomes available to trade again right away. Why might that be a better advantage, or why might you want to do that? Number one is the opportunity to close out the trade earlier and therefore increase trading frequency. The trade settlement, if you buy this option back before the market closes, rather than simply letting the option expire, means that the capital comes back to your account today and is available to trade, to use for another trade almost right away. So there's an advantage to that, given that you're able to place more trades in a little bit shorter period of time. By letting my option expire, I'm not going to be able to do anything with the $5,750 I have in capital reserve today, or over the weekend, or Monday. Tuesday probably will, but my next put selling trade isn't going to be placed until Wednesday. I always highlight my trades on Tuesday in on Discord or on Substack, and then I place the trade on the next day on Wednesday. So that's one of the reasons I don't mind letting this option expire. I don't really worry too much about the trade settlement element of this, and I have enough cash in the account to be able to place a trade anyway if I really want to. But just in terms of trying to maintain it and work within the time constraints that I have and the other demands on my time that I have, I'm okay with letting this expire. There is an advantage if you had another trade in mind right now, another stock that you were thinking about. I don't really see an opportunity to roll up right now on GIS that honestly looks that attractive. Let's see. Here's 27 days. Well, let me take that back. This might actually be something that would be interesting. This is not a recommendation. As always, let me swing my coward's door here. But here's the next expiration up is a little under a month now, 27 days, and still working 57.50, still about $2.50 away from the stock's current price. And right now you can get 95 cents on the bid for this. That's not, and it just increased to $1. So a little under 2% for basically a 1 month trade, 4 weeks on this is actually pretty attractive. And there's plenty of open interest here and some good volume here just to start out the day so far on this contract. So that does look interesting. Again, not a recommendation to buy or sell, but this does make an interesting case for this idea of rolling the trade, buying the option back before the actual expiration, so that you can turn around and place another trade more quickly. Who's to say where GIS is going to be on Tuesday or Wednesday? If we look at the chart, you can see that the stock has been tracing backwards a little bit for the last several days, dropping off of about $66 down to a low at around 58. And then right now, today, it's seeing a little bit of a bump. Now, it could continue to rally up towards the 20-day moving average, which is sitting right around 61. between now and Tuesday. But then again, who knows? 57.50 though does look like this is one of the reasons that I liked this trade when I set it up. You know, this $58 level now is looking like a very strong level of support. We have 1, 2, and now 3 pivot lows being formed here down at the bottom of this downward trend that began in September. So what we have here is a triple bottom starting to form. Again, I'm making an assumption when I say that the stock's price action is going to continue to move higher and use this as a real pivot low, this current level right around 58. If it does, then we have our triple bottoms. This is, let me go ahead and put a question mark here because we don't have the pivot confirmed yet on this third one, but so far we do have a double bottom, looks like a third, and 1, 2, 3 levels here where 58 has actually provided very strong support, and the contract that I've been working with is down here at 57.50. So that's one of the reasons that's been able to work out pretty nicely so far. So that's General Mills. Anybody else that's been working with this one? Again, this has been a little bit of a trade that's out of the norm from what I usually try to work with, but it's actually worked out pretty well in this particular case. So if you've been working with this as well, feel free to share your numbers. Let's compare. Barry you're not in that trade. Okay, that's fine. I say this a lot that not only do I not expect you to place the trade exactly the same way that I do, I give you the numbers that I'm planning to work with, and I highlight all of the details of the trade as I'm planning to make it. But that doesn't mean that I expect you to place the trade the same way. I also don't necessarily expect you to place the same trades I do every single time. You may decide for one reason or another that a stock just doesn't fit the criteria that you're looking for. You may have a better idea. Maybe the trade that I'm highlighting, like GIS, was a little over a month out, or maybe a month, something like that, and you find something that you think works better with a shorter period of time. That's fine. What my purpose in offering up these trading alerts is to show you what I'm planning to do. Give that to you as a reference to start doing your own analysis with. Now, I love it when we can compare numbers and when you can do a little bit better than I am. There's a little bit of competition in there in that's kind of fun, but I don't necessarily expect you to just take every trade that I'm making at face value. I like it when I can see you applying your own analysis and making your own decisions on the basis of that analysis and using that as a comparison, and then seeing how things work out for you as well. So, okay, so that is GIS. Looks like that one is in good shape. As I mentioned, I'm going to let that expire, and that's perfectly okay with me. The next one is a trade that went a full 30 days, and this is on a materials company that I've been following for about the last 6 months on FMC. I sold the 37.50 strike price on this. This was the week after I placed the trade on GIS, and selling the 37.50 brought in the same amount of $1.40 in this case, which is a much higher premium at the strike price that I was working at. So 3.73% was a pretty nice trade. Why was that so much out of the norm? Well, let's jump over here to the chart really quick, and we'll see. Now, the trade that I placed here was right here. So the stock. So this is after this last earnings report. the stock we saw this huge gap. This is an overnight plunge where the stock just falls from about $54 all the way down to into the 30s. And I'll be honest, when I first started following the stock, it was up here in the $60 range, and I thought it was a pretty good price for the stock at that level, based on my fundamental and valuation analysis. Obviously, the stock has only dropped even further from that point. We're looking at an overall downward trend on this stock that began all the way back here in the early part of 2023 from a peak at around $130. So this is a stock that is not only in its own bear market, but according to a lot of growth-focused investors, this thing is pretty radioactive right now. And this gap lower just kind of reinforces that idea. The interesting thing, though, is that despite the size of this gap, which was almost $20 per share overnight, the fundamentals on this are still really solid. And it's interesting to see that the way the stock has, from that gap, started to build a new short-term upward trend. Now, this has not been enough, nor is it enough yet to call for a reversal of the long-term trend. That's going to take quite a bit of time, and certainly we're going to need to see this upward trend extend into an intermediate time period and rally up much closer into the mid $50 range where the 200-day moving average is before a real trend reversal becomes a possibility. In the meantime, it's still got a lot of this gap that it's got to fill in order to really sustain this trend much longer. But in the meantime, selling the 37.50 strike price, not to toot my own horn too much, but the strike price that I sold is down around here. Stock's around 41.30. That's a nice result, and that's why sometimes these gaps look scary. And if you're holding the stock when they happen, this is a gut punch, to be sure. But sometimes if you see this happening to stocks that you're following, this is a good opportunity to double check the numbers and see if things are really as bad as they look. And a lot of times they aren't. Sometimes there's a good reason for the drop, and it points to other problems that the company is trying to deal with that may make you decide that you need to stay away from the stock. In the case of FMC, this was really just, the more I dug into the numbers, it really just had to be chalked up to an overreaction by the market. And so I placed this trade, and it's, again, just like with GIS, is in a good position now to expire worthless. Like GIS, this is also a stock that does not offer weekly options. So 37.50, again, not surprisingly, my asking price on this is about 5 cents. No activity in terms of volume today on this, but it's about 461 contracts. That is enough open interest to make the idea of rolling the trade worth thinking about. Buying it back at 5 cents, maybe hanging on to $1.35 again, more than 90%, 95% of the premium I brought in, and then deciding maybe what do we have here at maybe 40. Wow, look at this. Implied volatility here is still pretty high. Remember, the stock is up here at a little bit above 41. It is picking up some bearish momentum today, down about 2.5%. And it is clearly coming off of resistance here at a little under 44 and been retracing the last 3 days. But that said, the value proposition is still really nice on this. Fundamentals are solid, and buying back the 37.50 that expires today, possibly freeing up that capital, maybe thinking about selling the $40 strike for $1.20. That's 3% for 4 weeks, folks. That's nice. That's a good result when you can get it. I'm not saying you should or should not place this trade. I'm just saying that's really interesting. Again, not a lot of activity. Again, we're still just not even a half hour into the trading session today. And don't worry too much about that particular number in open interest. I don't take that as any kind of a sign, 666, but that is kind of humorous, right? There is plenty of open interest. The point is, if you wanted to be able to place a trade here at that $1.20 bid, you certainly could. Sorry, I have to laugh at this, 666. I think that's funny. But I have an odd sense of humor, so. All right, that's FMC. Again, if anybody wants to throw out the numbers they've been working with on this as well, again, I'm going to go ahead and let that expire worthless and see what is available again for next week. The nice thing here so far is that between General Mills and FMC Corp, I've got 57.50 plus 37.50 in capital, so $9,500 in capital reserve that is going to be coming back into my account and ready for the next trade. Still in my account, but it's going to be available for my next trade next week, and so that's kind of a nice result. I'm getting a little bit of flexibility, even more than I already had, which is always nice. There's also a covered call coming up here on DVN. This is a stock that I've held now for a little while. I was assigned my shares back in October. Excuse me, 1st of November on Devon from a put sale here that bought the stock at $39.50. And my covered call is at 40. This is a stock, a company I like that's a play on the energy sector, which has been a little bit volatile. When I placed the trade, the cover, when I should say when I was assigned, the stock was in this neighborhood. I placed the trade, the put sale here, and we've seen it just steadily go lower and then begin to consolidate over the last couple of months. But it's still certainly well off of the $40 strike price that I sold for the covered call and the $39.50 strike that I was assigned at. So still a little bit negative on this, but I've also been able to bring in some dividends on this, which are kind of nice. 22 and then 24. So management increased their dividend as of the last dividend payout, and so this is one of the reasons I don't shy away from taking assignments, and I'm willing to hold on to these stocks even when they're a little bit below the strike price that I sold. Dividend just represents a good passive income source. So I'll continue to hold these shares. It looks like that option is going to expire worthless. I certainly don't expect it to get up anywhere near to 40 today. It's certainly possible, just really doesn't seem likely at all. Let's see, Barry, barring an extreme uptick in price action, going to be assigned PII at $45 today. Did bring in 230 premium for a 4-week trade. Well, that's not terrible. And Barry, I appreciate the comment. Let's go ahead and check in here a little bit. Polaris Incorporated. This is a stock that is in my watch list. I watch it from time to time. I haven't placed a trade on it in a while, and I haven't done a detailed analysis in a little while. But excuse me, Barry, saying that you placed the trade. Looks like when it was around in this neighborhood with a $45 strike, so just a little bit above the 20-day moving average in this neighborhood. And this is a stock that is picking up some bearish momentum right now. Maybe as we're coming into spring and summer, the hope here is that maybe we get a little bit of boost in recreational activity that could give the stock a little bit of a boost. That would be kind of nice. But in the meantime, looks like your overall trade was a pretty nice setup, especially if Polaris is a stock that you don't mind holding, right? Caveat when you're working with put selling strategies, you're an income generator. The caveat has to be when you sell a put option on a stock that you are willing to you're willing to buy the stock at that price. You like the company enough that if you're assigned, that's okay. Even if you are planning to be an active roller, like a lot of people in Rebel Income are, there is still a tacit understanding that if the stock drops below the strike price that you are selling, you can be assigned at any point. So you have to be willing and ready and willing to accept that possibility and to deal with whatever logistics that creates for you. In my case, I take those assignments, and that's fine because these are companies that I'm willing to own anyway. I like these. Hopefully, Barry, that's the same here for you for Polaris. But being assigned at 45, sorry, my handwriting is kind of weird, and bringing in, you said $2.30. That is nice. So they do the math here for this. It looks something like, give me a sec. $5.11%. All right. Did not want to actually get rid of those, but that's all right. So 230 divide by 45. And I know that looks worse. 5.11%. And this was over 28 days. Well, Barry, you don't have a trade on GIS to compare to mine, right? But boy, you know what you do have? You do have a really, really nice result here, even on being assigned. And again, I am assuming Polaris is a stock that you're willing to own, that you like at that price. Stock is not so far off. You are about $4 below that assignment price right now, but that doesn't feel like such a far distance here that that it's really painful, right? And it does look like we've got some pretty strong support here around 40, with the stock starting to form a little bit of a pivot here and hopefully begin to move higher. I like it. This is exactly the kind of put sell that I like to see working with. Long downward trend. Stock is down here in the extreme low end. and starting to consolidate a little bit here at the bottom of this trend. Now, we saw some consolidation here from August to October that looked like it could have been the kind of thing that could start to reverse the trend. Of course, we know that that's not what happened, right? The stock bent over and then extended even further. So it's certainly not a given that what we're seeing here is going to be that kind of a trend reversal. Stock has a lot of room to move before you can really start talking in real terms about a long-term bullish trend here. But in the meantime, assuming this is the kind of bargain price that you're looking for, the value proposition looks good. You like it at 45. This looks nice. This looks like the kind of setup that I would gravitate to. I'm going to be honest. So, thank you, Barry. I appreciate you sharing that. That's pretty awesome. Okay. Okay. And Barry's on Devon at 55, 39, and 35. So your cost basis outside of dividends and option premiums is 43. And that's pretty nice too. So you've been able to manage it down a little bit, down into this range. And again, there's still some distance there, right? I'm at 40 just on my one trade, and the stock is starting to cheat up towards 36. That's good, but there's still some distance that we're looking for the stock to reclaim. But again, the dividend is nice. This is a good company with an attractive dividend, providing that passive income source. Here's 4%. Is energy going to increase? I don't know. There's enough questions around what tariffs are going to do in the long term to say that we just don't know. But in the meantime, these companies have pretty solid fundamentals. Companies like Devon and some of the other larger companies in the sector are generally pretty well positioned. So I like it. That's why I'm not afraid to work with these companies, and I'm willing to accept a little bit of volatility in these stocks, even under current conditions. And I'm certainly not trying to beat any particular political drum for or against what is happening in the political sphere. I do think the tariffs are going to be generally inflationary, right? Not only talking about tariffs the U.S. is imposing on countries like China, Canada, Mexico, but these countries are also retaliating with tit-for-tat tariffs. And so what you're starting is another trade war, just like we had in 2018. And that may be the kind of thing that we see a little bit more of a correction with. That's what we had in 2018 was the market corrected during the trade war. It had a bit of uncertainty, but that also, again, on these companies, a good company doesn't suddenly become a bad company just because some of the broader macroeconomic influences suddenly shift, not entirely in their favor. They just find new ways to try to manage, and so that's where some interesting opportunities from a long-term value-oriented perspective come into play. Barry, Devon was trading in the mid-50s in April of last year when I first got into it. So since you're trying to reduce your cost basis, and I think that makes sense. It's interesting. It is interesting, Barry, that you've got three different. You've taken assignments on this in three different stages. So your position size here is increasing with each one of those new assignments. That's not necessarily bad. I'm certainly not criticizing that approach. The one caveat I'll give to that for those of you who are still kind of trying to learn how to work with this is to be very, very careful about your position sizes. One of the things that I always try to encourage people to do is to try to think about how much of your capital you're putting into not only putting into the trade when you open it, but also try to think about the possibility of something like an extended downward trend. Like where Barry is saying, the stock is, in the mid 50s when you start working with it, right? And maybe you start to see bearish activity starting to increase. You like the company, so maybe you decide. I'm just going to throw out some random numbers here. Say you're working with a $200,000 account, and you want to try to limit your position size to no more than 3% of the account in any one trade. So 200,000 times 0.03. That's a $6,000 limit on any one position size. Now, if the stock is around 55, that means that you've got room for exactly one contract. Can't round up or anything like that. However, if you're working with maybe a little bit larger account, say you've got $1 million, now you've got about $30,000 to work with. What that does, admittedly, this is an advantage of having a larger account. So if you don't fit into this, then you're gonna be working with some smaller position sizes, just like I am in my account. I have about $290,000 in the account that I trade with this approach, and so that means that I'm not able to do what I'm talking about as often without accepting some additional risk. However, let's say that I'm working with $1 million account, 3% of the account is $30,000. If I'm looking at the stock at 55, that means that if I want to go in on a full position, I could sell. That's not actually correct. Sorry. 30,000 divided by 5,500. Sorry, I can use a calculator. There we go. Five contracts. So the total size of I can't round up. So since I have 5.45 here, there's no half contracts. So I can work with up to 5 contracts and still maintain my 3% position size on my $1 million account. That means that maybe initially, if I'm anticipating an extended downward trend, and I want to try to leverage that a little bit, instead of going in with the full position, all 5 contracts right away, maybe I sell 1 contract at 55. See what happens. If I get assigned and the stock continues to drop, then you can start thinking about doing something like what Barry has been doing. He said that the next one that he sold, so his first one was up here. I'm going to go ahead and assume, Barry, it's around in this area here, up at 55. And I apologize, my handwriting's terrible. Next one was around 39. So more likely to be down in this area. This is the next leg, in effect, of the position. And then you can maintain proportionality by selling another contract. Now, instead of, if you get assigned again, now instead of owning 100 shares, now you have 200 shares. So you're still not halfway in. Okay, Barry was in at 54, so I stand corrected. That's fine. We're still in the same. You're right. We're in the ballpark, and for the sake of of my illustration, it still works. So here's 39, and then a little bit more recently, here we are at 35. And so with those three positions, assuming I'm working with a $1 million account, right? I said from the beginning I could go up to as many as 5 contracts and still be within the limits that I want. Now, as I'm selling, as I'm being assigned at these lower prices, the actual total position size is going to be significantly less than the $30,000 max that I'm allocating to myself. That's also making the overall position more conservative. That's minimizing the overall risk exposure as well. Not only does that give you the opportunity of averaging your cost lower, then, but you're still applying some really sensible position sizing rules to the trade that make it a lot easier to see the stock begin to recover. And eventually, we do know. Here's what we do know. Good, like as I mentioned earlier, good companies don't suddenly become bad companies. A good manager doesn't suddenly become a bad manager. It's just that different elements are going to influence stock prices in different ways, sometimes for extended periods of time, to both the positive and the negative. But all trends are finite. Every upward trend is going to come to an end. It's the same for every downward trend, even the very extended ones. Devon has been following a downward trend now since late 2022. This is going on more than 2 years, folks. That's a painful downward trend. But at some point, that's also going to reverse. Bear markets only last so long. Bull markets only last so long. And again, the real question for my method boils down to not necessarily to what momentum is doing for the stock right now. It's part of the equation, but the larger question is really, what is the business worth? And if that is worth more than what the stock's price currently is, that's the opportunity. And that's why I like working with stocks that are down here in these lower ranges. It makes that calculus a whole lot easier. So that's Devon Energy. This is, again, I'm going to be holding on to the stock a little bit longer. Devon, Barry, looks like you are too. And that's not a bad thing. This is a position I don't mind holding for a little bit longer. Just be more opportunities to bring in some more passive income, either with covered calls, keep taking in my dividends. Okay. Let's see here. Going down or up the roster, I guess I should say. Next one is a put sale on Skyworks. This was a trade that I placed last week. This was a very near-term trade, only 9 days, selling the $67.50 strike. Might sound a little bit of a risky play the way that some tech stocks have been behaving lately, but I was able to bring in a little under 2% for 2 days, for 9 days of time, for just a little bit over a week. That seemed pretty nice, especially since the value proposition for Skyworks was also really, really nice here. So let's check in really quickly with the stock, see where we're sitting. And had a little bit of a dip early in the trading day here, but it's starting to rebound a little bit. And right now sitting at 68.43. So up about 4 cents. It is possible here that the stock could still drop back. Looks like the low for the day was at 67.11. So it actually dropped below the strike price that I was assigned originally. Just talking about today's activity so far, or the strike price that I sold. It is still possible the stock could drop back before the market closes today. I could still be assigned. I'm certainly not going to suggest otherwise. but I'm also okay with being assigned at 67.50. The pattern on this is not exactly the same as FMC, but it's kind of similar too, right? Because we see also, here's the big overnight gap on the earnings report, with the stock starting to stabilize just a little bit. Change my color. There we go. Stock starting to stabilize just a little bit since then. We are seeing it also, it has been retracing the last week or so off of this resistance at about 72. So we will ultimately have to just I'll just have to let this play out, see what this looks like. Now, this is a good one for this is a nice one to take a look at and think about what the advantage of maybe closing this out before the market close may be. Okay. So really quickly, brought in $1.25 on this one. And 67.50 contract on this. The asking price is 20 cents right now. No volume, but a lot of open interest here. Not just it dropped briefly down to 15 and then spiked again. That's interesting. No contracts changing hands, but the price is being highly variable here as people are putting in different prices here. Let's just go with this 20 cent ask right now. Just go with 20 cents. That means if I were to buy this back right now, I could certainly get that. Look at the way that it, as variable as it's been, I'd be able to get 20 cents, I believe. That means I'd hang on to $1.05 of the premium that I brought in. I would close out the obligation. And considering how close the stock is to 67.50, if the idea of being assigned makes you a little bit nervous, that wouldn't be the worst idea here. It would eliminate the obligation and free up the $6,750 that I put on reserve. Now, my method is my method. I'm going to let this play out, and if I get assigned, I'm okay with that. I'm just saying, if you are the type that isn't really as content with taking an assignment as I am, then buying that back may make some sense. It is interesting to think about the possibility of buying that back, and look at this. You can actually roll down and forward, if that makes sense. Now, when I say down, I mean down to 65. You can sell a lower strike price for the next month. That's the forward part, forward in time. So down to a lower strike price, forward in time, 27 days, and bring in $1.10, a little under 2% for 27 days. If I like Skyworks at 67.50, I like it better at 65. So that's not the worst idea. Not a recommendation, as always. I'm going to keep my coward's door swinging here, but in terms of choices and alternatives, these are some interesting ones. And if you wanted to work with the same 67.50, you can get $2 for that right now. Again, for the next month. Not a ton of open interest or volume, but there's enough. You'd be able to work with this one pretty quickly. So again, if anybody else has some other numbers you'd like to use or throw out to the group for comparison. Those will be interesting to see. Okay. The last one on deck for today is a covered call on Coterra Energy. This is a stock I was assigned at $27.50 back in 2024 in August. Here's the $27 assignment. Held it ever since then, and watched it. I've had to watch it go through a bit of a slump, a downward trend. Again, that's going to happen sometimes. It was up here when I placed the trade, watched it fall and stay down all the way through the end of 2024, I mean. Saw a big rally initially, gave me a covered call trade here, then it retraced back, and now we're back here above 28, a little bit below 29 now. Now, this means I'm going to get called out, which is good, but it also means I've capped my profit at $27.50. I'm only going to make 50 cents on the sale of the stock when I get called out. Going to miss about $1.50 if the stock's price holds at its current levels. Okay. This is one of the things that you have to keep in mind when you're selling a covered call, is that you are putting a literal cap on how much gain you're going to see if you are called out. Why do you do the covered call then? This is going to be one of the things that a lot of the people that I know that focus on growth, they struggle to understand. Why do the covered call in the first place at all? No, because of the income. It's the opportunity to pick up 45 cents per share on a stock that I already own at a lower price and build in a little bit of capital gain. But the reason for the covered call is 1.67% yield over a 9-day period. That's the low-hanging fruit of the market that growth investors almost always just seem to ignore, and that just passes them by. I love being the guy that gets to pick that up. This is how I've built the account that I'm looking at, from $100,000 originally when I first started placing these trades, up to where it is now. Has been just by picking the low-hanging fruit of the market. Barry, this is one of the reasons I do not do a lot of trades on monthly options, and that's okay. You get more activity on stocks, certainly, that offer weekly options than monthlies. But if the numbers work out, if the numbers are still there for monthlies, as you can see, I won't shy away from them. If they're workable, if they're good enough, and that's really the question that each one of us has to answer is, what is good enough for our purposes? For me to continue to build the account that I have, as I have, in order for me to accomplish the goals that I've tried to set for myself, and to be, while also just being able to keep my system working the way that I want it. 1.5% per month. That's the target that I'm looking for. That's good enough. Anything above that is just gravy. So, yeah, Barry, I don't totally avoid the monthly, but mostly on stocks I want to own for a time element. There you go. Yeah, I'm with you. When I can, if I have a choice between a stock that offers weekly options and a stock that is only a monthly, all things being equal, I'm going to go with the stock that offers weeklies, right? Because there's going to be more of an opportunity to leverage trading frequency in my favor, and there's going to be more of an opportunity. There's likely going to be more activity, more liquidity going on, therefore better opportunities to manage the trades the way that I want. So, yeah, I'm certainly not disagreeing with you at all. So, yeah, Barry, you did ask, and we just do have a little bit of time left. Thank you for the reminder. I appreciate it. Question about Paramount Global. And if you've been following my trades at all for a little while, you know that I'm in at Paramount down in the 50s, and I've been watching it just extend through this long downward trend ever since. And I started working with it all the way back here. It did this Reddit-driven thing in 2021, and as it came back down, I started working with the stock in that range, and it's just continued to talk about a downward trend. It's continued to fall. Now, last year, in the summer, there was announced that Paramount Global was being sold to a company called Skydance Entertainment. There's a letter that was filed with the SEC this week that a lot of us got about some choices we have to make about how about that transaction. I can't tell you what you should choose to do, but it offered the letter offers some different choices. There's an element of unpredictability about this acquisition. I saw a news item this week, Barry, after you sent me the message about Para, that looks like there's a good chance that a judge in Delaware is going to block the acquisition. Apparently, the primary shareholder of Paramount Global accepted the buyout from Skydance at a much lower price than what a competing bid was for, and so that's what sparked the lawsuit. How does that translate to what would happen to us as shareholders in Paramount? A lot of that is really still to be seen. I'm not sure if that means the company would be taken private, or if it would still exist as a public entity with a different name. That has not been totally established. I know, Barry, that probably doesn't answer a lot of your questions. So we're just going to have to kind of wait and see how that plays out a little bit. In any event, we are at time, so I do appreciate everybody who's been in the webinar today, and thanks for participating. Appreciate your comments and for being here. Hope you have a wonderful weekend. If there is anything, Barry, you are in at a much lower price, so the $15 tender would put you in at a gain, and that's a good thing. The tender offer at 15 just means I would still be looking at a much. I would still be in the hole. So the question is, is the stock going to be likely to recover from that point, or is it just going to be taken private? I'm not sure. I might have to eat that loss in that case. So in any event, thanks again, everybody. I hope you have a wonderful weekend. If anything comes up between now and next Friday, don't hesitate to let me know. Otherwise, have a wonderful week, and we'll talk again next time. Thank you.